Well, here we are in the end of the first week in June. I was hoping for some more clarity on the stock correction, and we've gotten some, but it's actually gone both ways in the last week. It was looking like scenario one was more in place, a shallow correction before we keep heading up in this dark window last great thrust in the stocks. But the sharper dip early this week before the bounce that we've seen recently actually put us closer to scenario two. Now, not rock solid, but it makes scenario two a deeper correction, maybe even a retest of the lows, a bit more likely. So I think it's still time to watch the markets. I'm going to have an update on that and 5-day forecast for boom and bust subscribers. So look for that on Monday. But while we're watching this greatest bubble of all times, or at least in modern times, and especially for the US and global trends today, you've got to remember what happens on the other side. How much money disappears. Money is not M2 or M3 as described in economics. Money is that plus all the wealth. People's house, real estate equity, their stock ownerships and bonds and brokerage accounts. All of these financial assets are wealth, and that is money that can be spent out of such accounts or borrowed against in the case of your equity in your home, even if you don't sell it. And that's real money. And what I'm saying is after a debt bubble and a financial asset bubble, which always follows those, you always see wealth, literally money, disappear and not come back for a long time, and you see debt deleverage. So I just want to give you a feeling for that. I remember several months back, there was a McKinsey study that said there's $300 trillion of financial assets. Now they describe that as stocks, bonds, and loans, because loans are like bonds. Financial assets, and I looked at each of those categories and how much they could deleverage in a major downturn that I'm talking about. And I came up with about $120 trillion. Let's say $100 to $120 trillion could disappear. And I'm sure that number is at least 320, maybe 330 trillion by now. So even more of anything. That's a lot of money and buying power to disappear. You can see why you get deflation in prices, but the big deflation comes in asset prices. It's more minor in consumer prices with less buying power. And let me throw some other numbers I just got recently. If we look at net worth, total net worth in North America in 2018, $106 trillion. This is the real wealth of consumers in US and Canada. Well, I look back, what if that just dropped back just to 2008 levels? That would mean 58 trillion, that $48 trillion of wealth would disappear. And again, when we have great resets like this, like 1929 to 32 or 1837 to 42, the prices, the asset prices, whether it be real estate or stocks, don't get back to those levels for 25 years and are very slow to advance at first. So this is like money that's gone. Europe, 85 trillion. I'm saying that would go down a little less overvaluation, say overall in real estate and stocks. That's still 34 trillion could disappear. China, which is heavy on real estate, China's real estate is like about $40 trillion in net worth. Their stock market's only $6 trillion. So they're at 75% of Chinese net worth is in real estate. That's going to go down the most, 60 to 80%. I'm showing Shanghai should go down 78%, but let's say real estate overall, more like 60%. That is the worst it gets. I'm talking about 40 to 50% in the US, worse than last time, but nothing like 60 or 70 or 80% in China. China's got 52 trillion in net worth, most of it in real estate. That should drop in half, another 26 trillion, poof. Then the rest of the Asia Pacific region, India is only 6 trillion, Africa 8 trillion total net worth. So that we just focus on these major regions, 57 trillion there, and I get that 26 trillion could disappear. So out of that adds up to 300 trillion, very similar to that financial asset number globally, and says, I'm calculating $137 trillion of that disappears. Money that's no longer there for people to spend and feel wealthy. And of course, that's what causes a depression. People don't spend as much, they don't feel as wealthy. Assets deflate, debt against those assets, especially real estate, deflates, debt is restructured, and every time a loan is restructured or written off, money disappears. So that's what we're looking at. US stock market, just to show it's not as big. 30 trillion, that's the biggest by far, 30 trillion in the market value of our stocks, and easily 2/3 of that, 18 trillion, could disappear. But look at China, 6 trillion, maybe half of that disappears, 3. So the US is going to get the biggest hit in stocks along with Europe. China is going to take the biggest hit in real estate. In fact, even though China's economy is only about 80% in US dollars of the US, so they will pass us one of these days, but they haven't in US dollars yet. Their real estate market is actually 42.7 versus 42.3 versus their real estate market is worth slightly more and is much more overvalued. So again, what happens in a world when 100 to 120 to, in this net worth estimate, $140 trillion of financial assets, net worth, wealth of people disappears? I'll tell you what, it's going to be the #1 solution to the inequality problem in the world. Yeah, governments will raise taxes on the rich and the things go down like they did in the Depression, and they'll spend more money on projects and new welfare plans or whatever. And that will tend to counter the extreme income inequality of now and what we also saw in 1928, 29. But the markets are going to reset this. The top 0.1 and 1% and 10%. 10% of people control 80, 90% of the net worth. 0.1% controls 20 to 25, and the 1% by different measures, 40 to 50%. So this is going to level the playing field the quickest. Financial assets are dominated by the wealthiest people, and they will take the biggest hit. Homer Simpson, average people will lose some home equity more than stocks. They may lose their job or have less job security. No question about that. That hurts. But when it really comes down to it, it is people like our subscribers. It's people like you that we're trying to protect from losing your wealth when this once-in-a-lifetime great reset occurs. And again, our indicators are targeting this. We go on and measure this bubble in more and more ways, and now we've got our 90-year cycle, which really hits late 2009, early 2020. 2020 to 2022, when the most of this great reset is likely to happen. You need to avoid that. Yet, indicators still say that the dark window is still in play, and we're likely to see sharply higher stock prices before we see that crash. But when it comes to real estate tends to peak earlier than stocks, as it did in 2006 in the US, and real estate gets illiquid faster. So you better be working on your real estate now and be looking to work on restructuring your stock portfolios and your risk exposure in the next several months. We will keep you updated.